Hi, I'm David Scranton, and thank you for watching this video. You know, over the last month, we've seen the stock market reach new record highs, but we've also seen it drop, officially entering correction territory toward the end of January. So will the market continue its wild ride into the spring? And most importantly, what does it mean for income investors in retirement? Well, here to break it all down, we have my good friend, Michael Eastham, founder and president of Fellowship Financial Group, a retirement income store located right outside of Orlando, Florida. Michael's also the Amazon best-selling author of the book, Common Sense Income Strategies. Michael, always great to be here with you. Thank you.
Thanks so much, Dave. It's always good to be here.
So, you know, you talk to people every day in the Orlando area. You know, how much did this market drop that we saw, this whipsawing, if you will, of investors, how much did it spook the average person that you're talking with on a daily basis?
I think it always raises an eyebrow, and regardless where you sit on the spectrum, it seems to create phone calls or it seems to create questions in people's minds. But the thing that I try to help them to remember is that because of the way that we are allocated for the majority of our investors, the flip-flopping of the market doesn't typically impact their goals and their strategy, which is focusing more on generating interest and dividends and predictable income.
How about inflation? So people are concerned about it, but luckily, if they're your client, they've been, you know, invested in a more protective way, which is great. So they've been somewhat insulated from that. But inflation, I mean, inflation's something that's hard for all of us to insulate people from, right? So is that a big concern that you hear about on a daily basis?
Well, inflation is a tougher one to ignore because the fact that that the inflation that we're seeing right now is much higher than we've experienced in the last several years. It's of concern to people just because of there are a lot of moving parts. You know, first thing is, even though I try to tell them, okay, the higher amount of inflation isn't going to last forever. The fact is, once prices go up, especially wage-based prices, that they don't come down again typically. And so you have to build that into your strategy. We look at things like if you're not spending all of your income, well, that works really well in our situation because we can reinvest dividends and interest and build a natural inflation hedge for a lot of our clients. And we try to help those folks recognize that that not spending all of your income is actually a good thing. And we can take advantage of new opportunities that come along, especially when we start to see interest rates rise a little bit.
Mm-hmm. Now, it's interesting. We've seen some news come out recently. For example, the last jobs report was actually quite weak. But I think most average folks don't really pay attention to that. You know, we do, but they don't. But in general, you know, are people still pretty optimistic, or do you feel a little change in sentiment when you meet people for the first time these days?
Yeah, it's kind of a funny question because one of the things that I tell people is that when I sit down with them, a lot of times they tell me I stopped listening to the news because it's so pessimistic and there are so many problems that exist out there. And I have to come back to them and say, well, that's nice that you can turn it off. I can't. I have people like you asking me questions about it and expecting answers. But generally, there is an uncertainty that exists. There's I'd say borderline uncertainty / pessimistic, generally speaking. And I think that is a concern. I think that's something that we try to put on our psychologist hat for a lot of people and help them navigate through it so it doesn't become an emotional thing for them. If our clients are not yet retired and they're still a few steps away from retirement, well, then we look at it one way. If our clients are already retired, then we have to help them to recognize, look, we have to take all the information that we have, make the best decisions we can on a day-to-day basis. And that's one of the best ways that I found to help them to not let it become an emotional thing, but help them to factor it into their planning and give them some peace and comfort as they move through all of these uncertain times.
Yeah, of course. That makes sense to me on every front. Getting a little bit more granular, we know one of the big risks out there today is the Fed. You know, the Fed waited a long time to start to raise interest rates to stave off inflation. Now they're jumping, they're promising maybe 3 or 4 rate hikes. Is it too much? Are they going to create a recession? Or what are some of the other risks you see this year in the financial markets? And what are your thoughts? Are you generally, when you put all those things in a blender and push the button, are you generally optimistic about the financial markets throughout the rest of the year, or are you more on the pessimistic side?
Well, I think we're going to see flat growth in the market, meaning that we'll see a little bit of an increase potentially. I think it does depend, though, on what the Federal Reserve does. I mean, if we see 4 rate increases, then I think it could stir some recession. I think the biggest temptation that people have to avoid when it comes to this type of change is the temptation to move too far up the risk curve if you're retired. I think people start to look at not getting enough growth in one particular area and saying, wow, where can I go to find some better returns? And it pushes them too far up the risk curve. We've seen that a little bit in the past, but I keep coming back to my reality that the federal government can't afford to allow rates to get up too high simply because of nearly $30 trillion in debt. So I do think there's a fine balance between saying, okay, we're going to push short-term rates up, but at the same time, we've got to manage not allowing, unfortunately, it's a manipulation of the longer-term rates, treasury bonds, et cetera. They can't really afford to let those go up too high. So there's a fine balance there. It literally is a tight wire act for the Federal Reserve. I don't have a tremendous amount of confidence in their ability to make it all happen, but I do think overall that for the next 12 months, we're going to see relatively flat, possibly a little bit of increase, unless we see as many rate hikes as the Fed's talking about. We see 4, I think we're going to see a correction in the market.
Okay. So let's say we do get more conservative and people go more to bonds and bond-like instruments. They go in that fixed income world. Well, we all know when interest rates go up, bonds tend to go down. So what does that mean for the more conservative income investors throughout 2022 or maybe even into 2023?
Well, it does.
How do you protect them from that?
That there's a much more of a focus on buying and holding to maturity, because our clients understand that if we own individual bonds, then maybe it's not the highest interest rate that we got, a year or 2 ago. But the fact is that even though the market value may decline because interest rates go up, as long as the company stays strong with their cash flow, then we're going to get our money back when that bond matures. And so we're not going out 30 years on these bonds. We're going out at a moderate level, a reasonable duration, so that we are somewhat protecting them. And also, as those bonds mature, they don't mature all at the same time. That gives us the ability to reinvest at those higher interest rates and take advantage of times when the rates do go up.
Yeah, all very true. But bottom line is, even if you're concerned about not enough yield, maybe in more conservative investments, or having to go too short term or squash your yield down more, it's still not worth, bottom line, of getting pushed too far up the risk curve, because you never know when you have a black swan event and you're looking at another 50% drop that most income generation members simply can't afford to take. Michael Eastham, as always, our pleasure. Thank you.
Thanks so much, Dave.
Thank you for watching today's market update video. If you enjoyed it, click the thumbs up button, give us a like, and make sure that you subscribe to our YouTube channel for new content each and every week.